The M2 money supply is a key measure of how much money is circulating in the U.S. economy, not just physical cash, but also near money that can quickly be spent or invested. M2 includes M1, which is most liquid forms of cash, such as physical cash, coins, and checking accounts. On top of M1, the M2 money supply also includes savings accounts, money market accounts, and CDs. Now, what does this mean for inflation? Well, when the M2 money supply increases, it means more money is available to consumers, businesses, and investors. So a rapid increase can lead to higher spending, asset appreciation, and price inflation. But most people won't be prepared for the increase in everyday costs. So the best way to save yourself from the pain would be to invest heavily in index funds and assets with intrinsic value or positive cash flow. Bitcoin and gold have also been great options lately, although crypto is a bit more risky. The Federal Reserve monitors M2 as a signal of economic momentum, inflation risk, and liquidity in the system. It's one of the most important yet least understood indicators in macroeconomics. This chart shows the M2 money supply increasing at an accelerated rate in the last 12 months, which means the Fed has quietly been printing money again without cutting the interest rates yet. But M2 is still growing. This happens because the Fed has slowed down quantitative tightening, meaning it's allowing fewer bonds to leave its balance sheet. This keeps more money in the banking system, which supports lending and deposit growth. Liquidity programs like the Bank Term Funding Program and reverse repos are adding additional cash to the system to help banks and markets without changing interest rates. At the same time, the government is spending heavily and issuing new debt, putting money into the economy that ends up in bank accounts and assets. So even without cutting rates, the Fed's actions in the broader financial environment are causing the money supply to grow, causing uncontrollable inflation. One benefit of the increased money supply is that they can stimulate economic growth by encouraging spending and investment, which helps businesses expand and hire more workers. It also makes borrowing easier for consumers and companies, allowing them to take loans for big purchases or business expansion. Additionally, more money often flows into assets like stocks and real estate, boosting their prices. Increasing the money supply can also prevent deflation, which is a dangerous drop in prices that can stall the economy and lead to a recession. On the downside, increasing the money supply carries the risk of inflation, where too much money chases too few goods, causing prices to rise and reducing the purchasing power of the dollar. It can also lead to asset bubbles where prices of stocks, housing, or cryptocurrencies inflate beyond their true value, risking sharp corrections later on. A larger money supply may weaken the currency's value internationally, making imports more expensive. Finally, if the economy grows too quickly due to excess cash, it can overheat, causing imbalances and market volatility. Overall, asset prices are likely to trend higher over the next 24 to 36 months as the M2 money supply continues to expand and the Federal Reserve gradually shifts towards a more relaxed interest rate policy. However, this trajectory may be influenced by key macroeconomic headwinds, including rising unemployment and ongoing tariff uncertainty, which could either dampen or accelerate the inflationary pressures. If you found this helpful, smash that like button and subscribe for the latest financial insights and news.